November 1923. You are standing in line at a bakery, clutching a bag containing 200 billion marks. All you want is a single loaf of rye bread. The baker looks at you, then at the clock. He says, "The price just went up, sir. That would be another 50 billion. You reach into your coat. You do not have enough. Silently, you gather the notes back into your hands and walk out. You will sleep hungry tonight, and so will hundreds of other middle-class families like yours. Teachers, clerks, shopkeepers, people who saved, who trusted the system. Your salary still comes in, but by the time you touch it, it is worth less. Every hour it shrinks, and while you leave the bakery empty-handed, someone else is acquiring factories, land, foreign currency, hard assets, for cents, on the dollar, because when money collapses, wealth does not die, it moves. The question is, to whom? To find the answer, we need to zoom out to the mechanics behind every monetary collapse. 1914. Germany drops gold. War starts. Instead of raising taxes, the government borrows. You are told the debt expansion is temporary. The plan looked wise. The war would be short. Germany would win. Victory would cover the debt. The extra money could be withdrawn later. But war rarely respects projections. Germany lost the battle. In 1918, the debt remained. In 1919, the Treaty of Versailles imposed severe reparations. In 1921, the government fixed those at 132 billion gold marks. Germany did not have the gold, so it printed paper to buy time. At first, nothing looked catastrophic. Prices rose, but gradually. Wages adjusted. Businesses stayed open. The cafes were full. People still planned weddings and holidays. It did not feel like a collapse, but your behavior has changed. You hold less cash and spend sooner. 2 more years pass this way. Then 1923 hits. French and Belgian troops occupy the Ruhr, Germany's industrial engine. Berlin tells workers to resist. They go on strike, but striking workers still need to eat. So the government pays them with newly printed money. Now printing is not a stimulus, it is survival. And when money printing becomes a survival policy, discipline dies. More notes chase the same goods. Prices move faster. Workers demand higher wages because yesterday's pay buys less today. Businesses raise prices because tomorrow's currency will be weaker. Everyone starts running. You rush to spend before the value evaporates. Shops rush to adjust before costs explode. Savers rush into anything tangible. Cash becomes something you hold only briefly, almost like a melting ice cube. And that is when your trust breaks. You stop treating money as a store of value when it no longer functions as money at all. But you do not lose hope. You already know, when one class of assets begins to die, a few others absorb everything. Money has 2 jobs. It lets you transact, and it stores value. The first job usually survives longer. The second one does not. When you stop holding money, prices accelerate. Economists call it velocity. It is how fast you are trying to get rid of currency. In 1923, Germany, wages were paid multiple times per week. Workers ran from the payroll to the shops. Shopkeepers were priced several times a day. Everyone spends fast, because tomorrow the money they hold will be worth less. Meanwhile, cash savings are dead. Fixed pensions do not exist anymore. Government bonds, denominated in marks, are obliterated in real terms, and life insurance policies are hollow. On paper, the numbers remain. In reality, purchasing power drops to 0. When the unit collapses, every promise written in that unit collapses with it. Now, let us zoom forward to 2026. Today, global sovereign debt is at an all-time high. Pensions depend on the government IOUs. Asset prices have outrun real wages. The currency has not collapsed yet, but the setup rhymes. Debt expansion, asset inflation, income stagnation, and growing dependence on paper promises. Is history repeating itself? If yes, then which assets protect you, and which ones go to 0? The answer lies in history itself. If you have liked this video so far, hit subscribe. Back to 1914. Berlin. Your currency still works. Your savings sit in the bank. You own government bonds, the safe kind, backed by the state, paying steady interest. You feel responsible, prudent. Then the war stretches. Debt expands. Printing begins. By 1918, $1 buys 4 marks. What is the big deal? You tell yourself. Years pass. At first, changes are subtle. Food costs a little more. Coal, a little more. Wages adjust, but always slightly behind. The early 1920s pass in slow decline. The mark weakens steadily. Imports get expensive. Your savings lose value. You are a little worried now. So, you start thinking in the short term. You do not plan 5 years ahead anymore. By November 1923, the situation is catastrophic. Now, 1 mark buys 4.2 trillion. Your currency does not work anymore. Every note printed diluted the ones already in your pocket. You thought your bonds would, but they do not. The certificate is still there. The interest payments still arrive. Your bank statement still shows numbers, but those numbers do not feed your family. They buy you nothing. You stare at the ledger. The savings you built for 20 years evaporated in less than 1. Overwhelmed, you sit at your kitchen table. Suddenly, someone knocks on the door. You open it. Your landlord is standing there. He shrugs. I cannot help it. The rent will be 50% higher this month. Life's become really tough. You look at him. You were expecting this. All right, sir. I will pay it by evening. You reply. Your pension is due today. That should help. By noon, it arrives. You hold the envelope for a moment before opening it. It feels like relief. By afternoon, prices have moved again. You count the notes once, then twice. The full month's pension barely covers the new rent. There is nothing left of coal, food, or medicines. And now you know, your insurance policy will not help either. Everything you trusted was tied to the mark, and the assets that could have protected you, you wish you had held them. Prices move again. Your pension is gone. To manage expenses, you reach for the gold chain in your drawer. You take it to the jeweler. He does not argue about the price. He weighs it, names a number, and finally pays you. For the first time in months, the transaction feels stable. That is when it clicks. Paper depends on trust. Gold depends on scarcity. It does not promise value later. It holds value now. You are learning this in 1923, but if you were living a century later, you would watch the same structure play out again. September 15th, 2008, the United States. Lehman Brothers files for bankruptcy. It is one of the largest U.S. investment banks. When it collapses, credit markets freeze. Investors panic. They sell what they can. Even gold drops at first. From $1,011 to $707 per ounce. It was roughly a 30% drop. Everybody thought that gold had failed. It did not. The Federal Reserve cut rates to near zero. It expands its balance sheet by trillions of dollars. From late 2008 to September 2011, gold rose above $1,900 per ounce. The era changes. Places change. But the order stays the same. Stress leads to liquidity shock. Liquidity shock calls for monetary expansion. And monetary expansion leads to metal repricing. But protection is not the whole story, because somewhere in this chaos, someone is not just surviving, they are growing. Back to Berlin. A few more days pass. One morning you take a different route home from the market. Your bag is lighter than it should be. Suddenly, you hear a mechanical hum. You look around and see the factory has not stopped. You stand there, genuinely confused. Money is dying by the hour. Your pension is gone. Half the street is shuttered, and yet, behind those walls, business continues, as if none of this is happening. You stop a foreman leaving through the gate. How is still running? He shrugs. Export contracts. Our clients are in Amsterdam, London. They do not pay in marks. He walks on. It lands slowly. His employer, Siemens, is not storing value. He is producing electrical grids, turbines, generators. The kind of equipment that does not stop being necessary just because a currency is dying. As the mark collapsed, Siemens repriced, export contracts renegotiated, revenue climbed. Their costs were in marks. Their income was not. The chaos in the streets never made it past the gate. You think about the men who bought government bonds in 1914. Responsible, prudent. Exactly like you, they lent money to the state, and that money got wiped out by every last penny. Siemens shareholders were not. That is not luck. That's the difference between a fixed claim on a dying currency and a share of something the world keeps needing. When currency collapses, wealth moves away from paper promises toward real production. You walk away. Today you need to meet your cousin. He is a farmer. You do not know how he has been surviving this crisis. All he owns is a few morgens of farmland. You take a train to Brandenburg, your cousin's place. The area has lush farmlands. You find him in field. He does not look worried at all. That surprised you. How are you surviving this? You ask him directly. He looks at you like the question makes no sense. Surviving what? He asks. You tell him your pension barely covers rent. You tell him you saved a fortune, and that could not buy you a loaf of bread. He looks back and says calmly, "My land feeds me, not the marks." It sounds simple, but it is not. Why your savings evaporated. His mortgage shrank, fixed in paper marks. The same inflation that erased your bank account quietly erased his debt. His land did not dilute. His soil did not reprice by the hour. It still produces. You thought sophistication was safe. Turns out production is. Century later, somewhere else, people would see history repeating itself. Zimbabwe, early 2000s. The government seizes commercial farms by decree. Agricultural output collapses. Farm values crash. Owners lose everything overnight. The land remains, but control changes. In other cases, families who kept productive farmland outside political reach continue producing while the currency disintegrates around them. Different countries, different era, but the same story. But land also carries political risk. It cannot move. It can be taxed. It can be taken. So it is not land alone that survives. It is productive land. Land tied to something world still needs. Your cousin's fields are still working. Your bonds are not. Gold saved you. Production strengthened him. And now, you know it. When paper fails, value flows to what produces. You are older now. Much older. Who left Germany in the early 1930s, moved west, eventually settled in the United States. You built again, slowly, carefully. You never forgot what paper did to you. Now it is 1973. You are 87. The world feels stable, until it does not. One morning, the radio mentions something about the Middle East. OPEC cuts oil supply. You do not think much of it at first. You have heard geopolitical noise before. Then the numbers start moving. Oil was around $3 a barrel. Now it is nearly 12. Fuel prices surge. Lines form at gas stations. Tempers rise. Men argue in parking lots. Stations hang no gas signs. Before noon. You've seen lines before. Energy sits beneath everything. Oil moves trucks. Trucks slew food. Natural gas heats homes. Fertilizer feeds crops. Copper runs through power lines at factories. You remember 1923. Money died, but wheat did not. Now, in 1973, money is not dying. Energy is tightening, and everything above it starts shaking. Food prices climb. Transport costs jump. Factories slow. Not because investors lost confidence, because fuel got expensive. And that's when it clicks again. In 1923, the paper failed. In 1973, supply strained. The trigger is different. The lesson is the same. You can dilute currency. You cannot dilute energy. You can print dollars. You cannot print oil. When systems strain, what sits closest to necessity survives. Gold preserved you. Production strengthened others. Energy powers both. And when energy moves, the entire structure moves with it. The oil shock passes slowly. Inflation lingers. But this time, it is different from that of 1923. You are not trapped in the mark anymore. Back then, even if you saw the collapse coming, you had nowhere to go. To get dollars, you needed connections, access, and permission. Now, you already hold them. Your savings sit in dollars. Your investments report in dollars. Oil is priced in dollars. Trade settles in dollars. In 1923, you waited outside banks while the exchange rate moved against you. In 1973, capital moves toward the unit you already own. That is the difference. When a weaker currency strains, imports reprice immediately. Fuel costs more, food costs more, technology costs more. But if you hold the stronger currency, the shock hits differently. You are not scrambling to convert. You are not watching the rate run away from you. You are already inside the system the world trades in. A strong foreign currency gives you mobility. And in collapse, mobility decides who survives intact. Historically, money never disappears. It just changes hands. Are you holding the unit that breaks, or the one that holds even in turbulence? Comment below.